Hello. For those of you that have not watched the first video of this video series, my name is Patrick Baranowsky. I'm a longtime certified divorce financial analyst and the founder of Baran Analytics. I welcome you to my video series that explains the characteristics, issues, and remedies for high asset, high net worth divorces. Divorce financial analysts compose a specially trained and certified subset of the financial analyst industry, and I've been helping clients achieve prevailing results for high asset, high net worth cases for over a decade. So I want to present you my unique and informed perspective. If you're interested to understand other important topics of divorce, I encourage you to check out my website, blog, my live meetups, and my other YouTube videos. You also can contact me directly. As I emphasized in my first video of this series, achieving a prevailing divorce settlement may be sophisticated, but it need not be difficult. This video continues the theme of your divorce's complexity and challenges being overcome by your improved education and your embrace of diverse expertise that includes both specialized legal and financial expertise. My high asset, high net worth video series includes 3 videos to canvass the important topics that you need to educate yourself. In the first video, we already discussed the distinguishing characteristics of high asset, high net worth divorces to establish your foundational understanding. This second video provides you a better understanding of issues and challenges you're likely to face. A subsequent third video will tie all this discussion together with prospective remedies to the issues and challenges we discuss in this video. Of course, with more at stake in high asset, high net worth divorces, issues and challenges magnify far more compared to typical divorces. Let's discuss some of the more prominent issues and challenges. For the first issue, when wealthy households divorce, their divorces tend to be longer and more expensive. Because more wealth is at stake, each argument likely will have more consequence. This means that more arguments likely will be pursued. In addition to wealthy households litigating more issues, each issue tends to be more complicated because the financials tend to be more complicated. As an example, wealthy households are more likely to face issues with business valuation, non-traditional income quantification, and non-financial asset valuation. Regarding the second issue, your divorce likely will produce far more data during the discovery phase, both from you and your spouse. During this phase, you and your spouse will request a large variety of financial data from each other, and this data will need to be organized, checked for completeness, and assimilated into a resource that will enable subsequent research and analysis. A typical case could produce 1,000 pages of financial documents from each spouse. High asset cases can produce 10 times that, sometimes 20 times that. Similarly, each spouse in a typical household may incur less than 1,000 bank or credit card transactions per year per spouse. However, a wealthy household can generate over 2,000 financial transactions per spouse per year. If either spouse owns a small business and conflates both business and household expenses, transactions can escalate by 10 to 20 times that. This is far too much data for attorneys to process, but more sophisticated divorce financial analysts will employ advanced data analytics tools and AI software to do so quickly and comprehensively. Regarding the third issue, divorce is a common impetus for bad behavior, and wealth increases the incentive for this behavior. Some spouses feel entitled to set money aside for themselves secretly. Perhaps they bought a lot of equity into the marriage, or perhaps they contributed a disproportionate amount of income during the marriage, or perhaps they sacrificed a greater amount of their career earnings as they supported the household. While some of these virtues can be capitalized through litigation, much cannot, and a spouse may find that hard to accept. To hide assets, wealthy individuals more commonly have access to expert advice and have knowledge of how to create more covert holdings, such as offshore accounts and undeclared collectibles. The fourth issue can be the most dire to the lower earning spouse. Rarely does a household have two high income earners. As I mentioned in my prior video, this means that one spouse likely earns over 75% less than the other spouse. Over time, courts have been less inclined to award lifelong alimony and instead favor a temporary financial rehabilitation or lump sum payment. Rarely can someone rehabilitate to earn an income that will support their marital standard of living. This creates an outsized importance that the lower earning spouse receive a generous equity ruling to retain as much of their standard of living as possible. The fifth item tends to be unique for wealthy individuals. Most high earners have successful careers as executives, politicians, medical providers, business owners, and other professions that require a discreet or favorable public opinion and profile. Divorce is a time when spouses frequently point out embarrassing or sensational flaws of each other. Think about the embarrassing testimonies on national television during the sensational Johnny Depp-Amber Heard divorce. High earners have extra incentive to limit their public exposure and the disclosure of these arguments. The sixth issue can be poison to your team. With how much you have at stake and how sophisticated some of the issues of your case likely will be, you absolutely need both legal and financial expertise. Unfortunately, it's common for attorneys to try to exclude experts from supporting their clients. By doing this, the attorneys can control and bill for every type of activity through the divorcing process, regardless of whether the activity is inherently legal or whether they are the best resource to perform the activity. And clients are far less likely to recognize an attorney's flaws. So the attorney avoids accountability and incentive to perform. Clients fail to gain a diversity of expertise. The clients lose the efficiency, deep expertise, and valuable second perspective that otherwise would keep their attorney honest, save them money, and produce more compelling arguments. Likewise with the seventh issue, some spouses seek attorneys that promise fierce representation or an ability to take their spouse to the cleaners. You cannot control the type of attorney your spouse will seek and retain, and depending on his or her choice, you may face much more conflict and expense. In these cases, the effectiveness and efficiency of your diverse team becomes even more critical for you to fend off your spouse's poor discretion. The eighth issue should not be surprising. With so much at stake, wealthier households tend to hire more prestigious and capable legal teams, including top lawyers and divorce financial analysts like myself. I've seen cases where one spouse was frugal with their legal team and the other spouse was not, and the outcomes were not pretty. For the ninth issue, close to half of spouses are unhappy with the terms of their divorce settlement. Wealthier households logically had much more at stake and likely were unhappier because losing any of their arguments were likely to result with greater losses. These spouses also have more financial means to pursue retribution or correct what they perceive to be as injustices. As a result, Wealthier households are at greater risk that some portion of their divorce settlement will be relitigated at some point in the future. The final issue is multifaceted, but I'll highlight a few key points on the next slide. There are many issues that commonly cause high asset and high net worth divorces to incur more legal expenses and take longer to settle. I'll discuss some of these. For the first item, as I mentioned in the first video, a common characteristic in wealthy households is the receipt of non-traditional income. In some cases, the timing of income could complicate analysis, such as for bonus deferrals and RSUs that have been granted but not vested. I had one case for which the spouse once renegotiated his executive contract to defer a sizable bonus during the marriage to instead be received after the marriage. This would have harmed my client, so I provided details for what documentation the attorney needed to subpoena and used that data to help make an equity argument and gain a sizable compensation for my client. Regarding non-traditional income, many executives are compensated in large part with stocks, which are distributed in units that can change value by the second as the market fluctuates. Your divorce financial analyst should help your attorney better understand how these instruments should be reflected as assets and/or income and at what value. Remember that income is one of the most important metrics that affects a divorce settlement because it's one of the primary considerations for equitable distribution, alimony, and child support. To the second issue, when spouses agree to separate, subsequent income and savings become the earning spouse's separate property. The more that a spouse is paying for household expenses with his or her separate income during the separation phase, the less that spouse is saving into his or her separate savings. Effectively, that spouse loses more wealth in settlement. Likewise, the more that a spouse is saving in his or her separate income or paying it into an asset like a home mortgage, the more that asset accrues hybrid separate value. Considering how much income a wealthy individual can earn per month and how many months a divorce can protract, the terms of a separation agreement can influence a settlement by millions of dollars or more. Surprisingly, attorneys rarely raise this issue, so this normally is the first discussion that I request with a client. For the third issue, more complicated asset and debt ownership tracing is sometimes the most valuable service that I can provide. As I've mentioned earlier, wealthy individuals tend to marry later and bring greater equity into a marriage, which is presumed to be his or her separate property. However, that asset may become hybrid or even fully marital property during the marriage. As I just mentioned, that person may then accrue separate equity in that asset during the separation phase. Bottom line, all this needs to be traced with a financial model to quantify marital versus separate values. The trace needs to be performed comprehensively and with credibility, which is best achieved from a divorce financial analyst. Regarding more complicated valuation and division, as I noted in the fourth issue, more assets and debts are likely to be classified as commingled and therefore harder to divide in settlement. I commonly see unusual and sophisticated assets and debts that need to be divided in settlement. At times, I've had to value assets such as RSUs, crypto, loyalty points, art, and collectibles. I've had to value debts such as timeshares and 401k loans. Even loyalty points frequently become a more valuable issue in wealthy households. Sometimes clients can own dozens of diverse investment accounts and asset types, and many of these may be quite difficult to divide or sell. Sometimes settlements involve quid pro quo that involves comparing values of pre- and post-tax investments, of current or deferred assets, or of financial or non-financial assets. Business valuations and personal goodwill calculations could be highly contentious and complicated. I recall one client that owned over 50 different financial accounts and others that each owned dozens of funds within a single account. I also recall many clients jointly owning accounts with children to try to use their children as a safe harbor for equity. Not all wealthy individuals are fully self-made. Often, wealthy families have received substantial inheritance or stand to do so in the future. Past inheritance can be treated as separate income and may require tracing analysis if the proceeds were commingled in marital accounts. On the other hand, regular family gifts can be treated by the courts as income when determining equitable distribution, alimony, and child support. In one case, I found that a spouse was receiving large annual cash gifts during children's birthdays from family members each year, and I used forensics to show that these cash gifts were used to purchase staples for the children and should be added to his income statement. When relevant, family-owned businesses introduce the most complicated and controversial part of a divorce case. The cash flow of these businesses needs to be assessed and translated into personal income. And businesses typically need to be valued so the other spouse can receive a buyout. Business valuations typically require at least 3 separate estimation methodologies be conducted and can get quite sophisticated. Often the accounting for these businesses is suspect, so I have had to completely reassess and reconstruct past company tax returns. In one case, I showed that a seemingly worthless business had plenty of value and earned my client a settlement of hundreds of thousands of dollars for a buyout. In another case, I was able to identify and estimate almost $1 million of my client's personal goodwill, which was his separate equity and not subject to buyout to the spouse. Regarding tax issues, wealthy individuals could be paying 37% marginal federal tax rates and could be spending close to 3/4 of their marginal income on various taxes. Many wealthy individuals either do not qualify for tax deductions or receive a prorated reduction. Whether increasing income or decreasing deductions, the tax implications of various aspects of divorce can be significant consequence to that individual. To complicate negotiations, the other spouse could have tax liabilities of as low as 0%. This creates an unbalanced and complicated negotiations dynamic. For example, the proceeds of interest-bearing accounts could be worth closer to 75% more to the lesser earning spouse. Not surprisingly, the greater disparity of income between spouses leads to greater alimony or lump sum payouts, or at least the greater disparity increases the likelihood and consequences of these types of arguments. I've helped clients justify tens of thousands of dollars per month for alimony, which could have a present value of tens of millions of dollars. As the last item points out, most states have different or no standard guidelines to calculate alimony and or child support when at least one spouse earns a wealthy income. For example, child support in Virginia deviates after the household income exceeds $30,000 per month. Pendenti spousal support standard guidelines are excluded if households include income that exceeds $10,000 per month. In many of these cases, alimony is the issue with the greatest range between what the two spouses are proposing to settle. That means this issue could be the most important issue for your legal and financial experts to apply their collective ingenuity. That concludes my video discussing the issues and challenges of high asset, high net worth divorces. I encourage you to view the first and last videos in this video series to gain a more comprehensive understanding. Remember, achieving a prevailing divorce settlement may be sophisticated, but it need not be difficult. That is especially true when you have a certified divorce financial expert that can appreciate the daunting situation that you are facing and cares to understand you and help you understand his advice. It's all about you. Please consider subscribing to my channel by clicking the subscribe button below. If you gained any valuable knowledge from this video, please click like. If you are interested to discuss further, please contact me directly. My contact information is available on my Contact Us page of my website, barananalytics.com. The URL is shown on the bottom right side of this slide. I look forward to talking to you soon. Thank you, and I wish you well.